Hi traders, Dr. Barry Burns here with Top Dog Trading. Alright, this video actually is accompanying an ebook that I'm a contributing author to that is being published by Trading Pub. And tradingpub.com, great place to go and get a lot of good trading information from a variety of different traders. So I encourage you to check out the website. And the particular ebook that I'm contributing to, along with other authors, is about maximizing profits while minimizing risk. So basically creating a good risk-reward ratio in your trades. And I wrote a chapter for that, and they asked me to put together a video to accompany that, and that's what I'm doing. So if you see this video in June or July of 2015, which is, I'm actually recording this on June 28th, 2015, and the book is not published yet. So when it is published, then I will put a link to that ebook below this video. And the book is set to be published August 1st. So after August 1st, should get that link and be able to share that link with you to the ebook as well. Okay, so anyway, my contribution really centers around finding good risk-reward ratios based on the 200 period moving average. Now, in my courses, I usually define trend as the direction of the 50 period simple moving average. And that is great, and I do use that consistently on every trade that I take. And I refer to that as the intermediate trend. I trade the intermediate trend because I'm generally a pretty short-term trader. I like to trade very accurate, precise signals. And the 200 simple moving average defines the long-term trend. So it can, if you're using that as your trend indicator instead of the 50 SMA, one of the advantages is that you can catch longer trends. But one of the disadvantages is it's a little more challenging sometimes to pinpoint your entries with accuracy. So anyway, we're going to talk all about that, and this video goes beyond what I talked about in the article. So I've got a couple of my indicators up here. Actually, these are the only two indicators I use. And so we've got my cycle indicator here, which is about timing. That helps me time when to get in, when to get out. And then the other indicator that I use is my momentum indicator. And that's about the strength of the market. And I did something a little unusual. Here you'll see I have wave counts on price, which is pretty normal. But then I also have something that's very unusual, and that's wave counts on momentum, and that's a very, very powerful tool. So those two things, using cycles, using wave counts on price, cycles for timing, and momentum, putting all that together with the 200 simple moving average, which is the purple line up here, that's what helps us to become more accurate. So the 200 SMA only provides two things, really. Number one is long-term direction of the market with regard to trend, and number two, it also can provide support resistance levels. So as you see here, provides resistance, and here it does not. Now I'm using a daily chart, and the two most common moving averages used on daily, weekly, and monthly charts are the 50 SMA and the 200 SMA. They're not as commonly used on intraday charts, but they still are often used. But when you go to long-term charts like daily, weekly, and monthly, then they are commonly used by a lot of people. Now, when we talk about whether support or resistance is going to hold, one of the things that we look at is how many times has it been tested. So once, twice, and then people are thinking, wow, this probably is not going to hold, and so it'll come down. Or it probably will hold because we've already hit it once. And so people see that, even if they're not using the 200 SMA, they see this high. Then, so it comes to it and it holds because everyone sees, oh, that was a value that people felt the market was worth recently, and not anymore. And so therefore, people are generally unwilling to pay more. However, if the market has enough interest in buyers to come back and test that same level a third time, then that's an indication that people's sentiment has changed, and that instead of them saying, yeah, the market's probably not worth that, now they've changed their mind saying, you know what, it probably is worth more than that. And so this is our principle of three that I use in my trading method. Principle of three applies in many different ways, but the number three is very, very, very significant and can be applied in many different ways in trading very powerfully. That's one example. So that's why for it to break through there is significant. Now, what we have here, we call this a, what we want is, see, the 50 or the 200 simple moving average. Okay, it's never going to be just a straight line because it is a moving average, and so to expect it just to be a perfectly straight line when it's flat is just unrealistic. So we look for the 200 SMA to be relatively flat. And then when that happens, such as in this case, we say that we don't have a trending market, we're just in a trendless market. So if you look here, you know, we can draw this, and that's a pretty trendless market, right? It's just 200 SMA is just kind of flat, just wiggling sideways and not really holding any direction. And that's the other thing, is we also look at how price responds to the 200 moving average. So here, you know, it went below, and then it goes above it, and then it goes back down below it, and then it goes back down above it. So again, that is a second indication with regard to price that the market is not holding to one side or the other of the 200 MA. 200 MA we consider a line in the sand with regard to long-term trend, and that is not being held. Therefore, we are in a trendless market. It's basically kind of a channel pattern, but again, don't rely on those to be perfectly accurate. Okay, now what we have here is finally what happens. The market comes back, and again it retraces back to the 200 MA. Now this time it holds as support. Okay, so now what we need to do is start looking at some of our other energies, as I call them. I trade what I call my 5 energy methodology, the top dog trading 5 energy methodology. So why would we expect, after it's crossed several times, first of all, there's a cycle in the market called the, well, I call it the order chaos cycle. And chaos is when the market is not trending, order is when the market starts a trend. And so after a period of chaos, which we just had, we start looking for the market to go into orderly patterns. So it's natural for the market to do that. Now, what's our indication here that this support will hold? The market will bounce off of the 200 SMA instead of or just slice through it like it did here. Okay, so one of the things that we would look at is, again, momentum. Well, we look at cycles. There's a nice cycle. This is what I call a second chance cycle pattern, which provides a very high probability cycle low. Okay, don't have time to go into all of that, but I give webinars on that most weeks, and if you're interested, just send me an email and I can send you an email back as to when the next webinar on knowing how to use the cycle indicator will occur. Now, the other thing that we look at is momentum, and again, as I said, I put wave counts on momentum. Now, the average wave count on a trend, and we have not been in a trendy market here, but the average wave count for a trend is 5 waves, and I'm not using Elliott waves. I have my own way of measuring waves, which is very objective, and we never recount. It can be more than 5 waves for that reason. We don't impose a wave count such as 5 on trend, but that's average. Sometimes we get 7 or 9 wave trends, or even more. Sometimes a lot more. But on momentum, the average trend on momentum is 3. It's only 3. But momentum actually leads price, so, well, that's another whole discussion. So when we get into 5 waves on momentum, that's extended momentum, and we expect then momentum to go in the opposite direction, which it does here. You see how that's a red 5 and that's a green 1? That means that momentum's gone to the upside. Now, we could wait for this to trade, but this is the professional entry here. You're getting in before it's obvious to everybody else, and that's because we're trading a momentum exhaustion pattern, and we're not waiting for confirmation. By the time you got confirmation, everybody sees it, everybody's in, and it's too late. That's how amateurs trade. So that goes up, and indeed, we put in our 5 waves, as you can see. So there's our 5-wave trend pattern, and that is your average reward that you could expect on a trend. Now, could it go up more? It could, but that is going to be your high probability exit right there, because that's an average trend. If you hang on and try to get any more waves out of it, you may. Hey, I've seen 20 or even 30 wave trends. And we do have ways of trading those and hanging into some of those. They're called mega trends. But this is where your odds are. So we have a high probability entry and we have a high probability exit. Neither one means it's always going to be that way, but that will be your best entry and your best exit the vast majority of times. Okay, and so then we come in, we put in a failed 7, actually. Now notice how this whole time we're staying above the 200 MA though. Now we come back down to it. Okay, boom, and then there's our first retest. So the first retest, we always look for an entry. To trade the first cross of price crossing 200 MA is not a high probability trade. And the better trade is to wait for it to retest. It's more high probability. And what it means is it's confirming that, yes, the market is aware of that moving average. And usually, again, the first time it went there, it will create a high anyway. And so even people who don't see it, the moving average, are still going to see the high there. And when it retests that and fails to go higher, then that's a good indication that we will go down. Okay. And this one turns into a mega trend, as I was talking about before, and you can see how, 21 waves. That's pretty crazy. So you can see the risk reward on these can be phenomenal. If you look at our price, here, again, these are just potential rewards, not necessarily what you would get if you were trading, but we're looking at potential risk reward ratio. Okay, and look at the price where we are on this as well, somewhere down in this range, right? Okay, then let's look at where we got in. So where would we get in is, again, right in here. So all we have to do is, now, there's different ways you can choose to enter. You could choose to enter below the previous low. That's a real, that's a big confirmation. I don't like trading that way personally, and I don't need to, because that's where my cycle indicator becomes so powerful. This is a very strong entry signal. You wait for momentum. If you wait for momentum to turn down, see how it turns red from green to red, so it's angling down. And a 3-wave is the average wave, so we expect therefore for momentum to be done going up and to start going down, which it does. Notice again, average momentum wave is 3, but that doesn't mean the trend is done going down. It just means you're going to have a momentum stalling for a few minutes, or a few days in this case, since it's a daily chart. But wave 3, that's an average momentum trend, therefore momentum is most likely done and it's going to actually go down. We want to go short on what? Down momentum. We're getting in early before it's confirmed. We've got resistance. And we just get in. Really, all we have to do is look at this bar where everything turns red, everything goes down, and then we would just enter 1 pip. In this case, since it's the actually the way I enter on spot forex is 1 pip plus the spread below the low of that bar. Okay, below the low of that bar right there. I don't want to enter on the spread because that's basically, I just consider that commission. Now, if I was you can use this exact same technique trading anything, futures, stocks, ETFs, commodities, whatever, and then you're just trading one, whatever, penny, tick, etc., below the low of that bar, but you've got to get these confirmations here. All right, and then again, because we're using such a long-term moving average, we're using the long-term trend, and that's what gives us the opportunity to have a very good win or risk-reward ratio. Because look, again, what's our, let me actually finish with this. This is a good way to really point out the potential rewards here. Okay, it's hard to even do this because it's so crazy. Okay, so here I'm going to do it this way because that gets a little too squished up on the scaling there. So our risk on this trade is, we would put our stop right above these bars, by the way. So our risk, that's our risk would be below this bar here, right? And our stop, our entry is down there, and our stop is up here. Okay, so that's our risk. Our risk is the difference between that. Okay, now what's our reward? Oh, I can't do it without taking that off. Okay, so I'm still going to have to squish them up for you. Sorry about that. Let's see how well we can do this. Yeah, it's going to be challenging. Oh, okay, that's about the best we can do. Oops, yep, we know. Okay, so our risk is, like that. And our potential reward is, like that. So, risk reward ratio, astronomical. Now, will they always be that big? Of course not. But these are the kind of opportunities that using a long-term moving average can potentially provide you when they do occur. Fantastic reward to risk ratio.